You check your bank account after a grueling month of work. You see the deposit hits, but it's significantly lighter than your gross pay. Nearly a third of your hard-earned money has been siphoned off by the government before you could even touch it. You pay for the roads, the schools, the military, and the infrastructure. Yet there's a small, exclusive group of individuals whose wealth grows by billions every single year, but who contribute a smaller percentage of their income to the system than a middle-class teacher or a nurse. You feel that, right? That pit in your stomach? That is the feeling of realizing you are playing a game where the rules are fixed. While you are worrying about tax brackets and withholding, the ultra-wealthy are playing an entirely different game, a game with a cheat code called buy, borrow, die. Today, we aren't just complaining about it. We're going to deconstruct exactly how it works, step by step, so you can understand the machinery behind the curtain. The irony of the American tax system is that it's designed to tax movement, not existence. Think about it. If you work for a salary, your money is moving from an employer to you. Bam! Taxed. If you sell a stock to buy a car, your money is moving from an investment to cash. Bam! Taxed. If you buy a pair of jeans, money moves from you to the store. Sales tax. But if you are ultra wealthy, you realize that income is a choice, not a requirement. That is the secret. By avoiding a traditional paycheck, billionaires can live lives of unimaginable luxury while technically appearing poor on an IRS return. It sounds insane, but strictly speaking, if you don't sell anything and you don't earn a wage, you have no income. And if you have no income, you have no income tax. The shocking reality is that specific mechanisms like the step-up in basis loophole are estimated to cost the U.S. government upward of $61 billion in 2025 alone. That number is set to rise to $68 billion by 2027. While you struggle with inflation and rising marginal rates, the top 0.1% are utilizing a legal strategy that effectively erases their tax liability. To understand how we reached this point, we have to look back to the 1990s. Professor Edward J. McCaffery first coined the term buy, borrow, die. Now, let's be fair for a second. The system wasn't necessarily built to be malicious. It was built on the concept of unrealized gains. This is a critical concept. In the eyes of the law, if you own a painting, a classic car, or a share of Apple stock that goes up in value, you haven't actually made any money until you sell it. This makes sense for a regular homeowner. If your house goes up in value by 50 grand, you can't pay for groceries with your kitchen tiles. You don't have the cash yet, so the IRS doesn't tax you. But for the ultra-wealthy, this logical rule became a blueprint for total tax avoidance. Historically, the U.S. tax code has prioritized taxing labor, that's you working 9 to 5, over capital. This has led to a systemic divide where those who earn a living pay more than those who own a living. We've created a structure where paper wealth is a shield. As long as you never realize your gains, meaning you never sell, the taxman never knocks on your door. So let's break this down into the 3 phases, starting with phase 1, the buy. The strategy begins with asset selection. This is where the wealthy differ from the average investor. The average person might look for investments that pay dividends, cash payments every quarter, or they might put money in a high-yield savings account. Scornfully, to the ultra-wealthy strategist, that is a mistake. Why? Because dividends and interest are taxable events. Every time that cash hits your account, the IRS takes a bite. Instead, the buy phase is about acquiring appreciating assets. We are talking about tech stocks, prime real estate in Manhattan or Los Angeles, or private companies. The goal is to buy things that grow in value without distributing cash. Think of it like a snowball rolling down a hill. As long as you don't break a piece off to eat it, the snowball just keeps getting bigger and the IRS has nothing to grab onto. They are building a massive reservoir of wealth that is completely invisible to the standard income tax brackets. And looking ahead to 2026, those tax brackets for high earners are set to hit 37%. Imagine making $1 million and handing over $370,000 of it. The wealthy look at that and say, no thanks. By buying growth assets, they ensure their wealth is stored in a format that the tax code simply doesn't recognize as income. It sits there, it grows, it waits.
Now, you might be asking, okay, they have all this wealth in stocks, but how do they eat? How do they buy the mega yacht? How do they fuel the private jet if they can't sell the stock? Well, welcome to phase 2, the borrow. This is where the magic happens. This is where the strategy becomes truly elite. If a billionaire needs $100 million to buy a luxury estate, they do not sell their stock. Because if they sold $100 million worth of stock, they would trigger a capital gains tax. Depending on the state they live in, that could be 20%, 30%, or even more. That's $20 or $30 million gone. Poof. Instead, they walk into a bank, usually a private wealth division that you and I don't have access to, and they take out what is called a securities-backed line of credit, or an SB lock. Here is the key. They use their massive portfolio as collateral, because a loan is not considered income, it's a debt. The money they receive is 100% tax-free. Read that again in your mind. 100% tax-free. They might pay an interest rate to the bank, let's say 5 or 6%. Oh no, they have to pay interest. But do the math. Paying 5% interest to a bank is significantly cheaper than paying 23.8% or 37% in taxes to the government. Plus, if they structure it correctly, they might even be able to deduct the interest expenses against other investment income. High-profile billionaires do this all the time. It has been reported that figures like Elon Musk have borrowed billions against their shares. This allows them to spend millions of dollars a month on borrowed money while technically having zero taxable income. Think about the difference here. When you use a credit card, you are borrowing money at 25% interest because the bank thinks you're a risk. When they borrow money, they pay minimal interest because the bank knows they are good for it. They are arbitraging the difference between the bank's interest rate and the government's tax rate. But wait, there is a catch, right? Eventually, you have to pay back a loan. You can't just borrow forever. Or can you? This brings us to the final and most controversial piece of the puzzle, the die phase. It sounds morbid, but in the world of high finance, death is the ultimate tax loophole. It utilizes a provision in the tax code known as the step-up in basis.
That sounds complicated, but simply put, here's what it means. Let's say you are a tycoon. Decades ago, you bought a share of stock for $2. Today, that single share is worth $15. If you sold it while you were alive, you would owe taxes on that $13 gain. That $13 is your profit, and the government wants its cut. However, under current law, if you die and pass that stock to your heir, your child, let's say, the basis of that stock is stepped up to the current market value. This is the mind-blowing part. The IRS forgets the stock was ever bought for $2. As far as the tax man is concerned, your heir acquired it at $15. If your heir sells that stock the very next day for $15, they pay zero capital gains tax. None. The decades of growth, the billions of dollars in appreciation that occurred during your lifetime simply vanish from the tax rolls forever. It is a clean slate. So how does this resolve the borrow phase? It's simple. The estate sells some of the tax-free assets to pay off the loans the billionaire took out while they were alive. Because the assets are now tax-free thanks to the step-up, they sell them, pay the bank, and keep the rest. The debt is settled, the taxes are avoided, and the remaining fortune is handed down to the next generation, completely wiped clean of the tax liability that a normal working person could never escape. It is a perpetual motion machine of wealth preservation. Now, if you're feeling a bit frustrated right now, you aren't alone. Policymakers are beginning to catch on to this cycle. The gap between the haves and the have-nots is widening, and this strategy is a massive wedge driving them apart. There are proposed reforms on the table. We need to talk about them because they might actually change the landscape. One idea is a withholding tax on borrowing. Imagine if, when a billionaire takes out that tax-free loan, the government stepped in and said, "Not so fast." The proposal suggests a flat rate, perhaps 10%, applied to loan proceeds secured by appreciated assets. It would act like a prepayment of future taxes. If you want to access your wealth, you have to chip in. Another, more aggressive proposal is a minimum tax for the ultra-wealthy that includes unrealized gains. This is controversial. It would force billionaires to pay taxes as their wealth grows year over year, rather than waiting for a sale that may never happen. Critics scream that this would hurt investment. They argue that taxing money that doesn't exist as cash yet is unfair. How can I pay taxes on my stock going up if I haven't sold it? But proponents point to the scoreboard. They point to the $60 billion plus in lost annual revenue. They argue that the step-up loophole has become a structural flaw in the American economy. It heavily favors the top 5% of taxpayers, who receive over half of the aggregate benefit of this rule. It is a subsidy for the rich, paid for by the working class. So, where does that leave us? Most of us don't have billions in Tesla stock to borrow against. Most of us can't walk into a bank and demand a 3% interest rate on a $10 million loan. But there are practical lessons to take from this. You don't have to be a billionaire to think like one. First, focus on asset location. You need to understand that wealth held in appreciating assets is more tax efficient than wealth held in income-producing ones. If you have investments that trigger high taxes, maybe those belong in your 401k or IRA where they are shielded. Keep the growth stocks in your brokerage account where you can control when you sell. Second, utilize the buy and hold mentality. Day trading is fun, but it is tax inefficient. Every time you sell for a profit, you trigger a tax event. The longer you delay the sale of an asset, the longer you compound your money tax deferred. You are essentially getting an interest-free loan from the government on the taxes you haven't paid yet. Third, for those with moderate estates, maybe you own a home that has skyrocketed in value over 30 years, understanding the step up in basis is crucial. Do not just give your house to your kids while you are alive if you can avoid it. If you gift it, they take your original tax basis. If they inherit it, they get the step up. That difference could save your family tens or hundreds of thousands of dollars. Ultimately, the buy, borrow, die strategy reveals a hard truth about our financial system. The path to true wealth isn't just about how much you earn. It's about how effectively you can avoid the movement taxes that keep the majority of the population on the financial treadmill. The system rewards ownership. It punishes labor. Is it fair? Probably not. Is it the reality? Absolutely. The best thing you can do is stay informed. Understand the code, and focus on building assets rather than just collecting paychecks. Because in this game, if you don't know the rules, you have already lost. Don't let the complexity scare you. Dig in, learn the game, and maybe, just maybe, start playing by the rules of the wealthy.